Janard Trust here. In this video, I'm going to break down a multitude of ways that you can use to invest in ETFs and mutual funds. But before I get into that, hit that subscribe button and the like button. I appreciate you. So the first way that you can invest in mutual funds is you can choose a brokerage account, right? So you can select a reputable online broker that offers access to a wide range of mutual funds. Now, here are the top choices in 2025, including interactive brokers. You have Vanguard, Charles Schwab, E-Trade. There's Ally Invest, JP Morgan, self-directed, and First Trade, all of which provide thousands of no transaction fee mutual funds and user-friendly platforms. Now, step 2 in that regard is open a brokerage account. Create an account with your chosen broker. So most leading platforms have no account minimums and offer, straightforward online application processes. So you may need to provide personal information like, you have social security number, whether, you have employment details and financial, background. So basically to comply with the regulations. Then next step in this regard is fund your account. So deposit money into your brokerage account using your bank, transfer or wire or other available funding options. So, keep this in mind. Most brokers allow you to start with as little as $0. That might be hard to believe, right? And then you're going to want to research and select mutual funds. So use the broker's mutual fund screener and research tools to compare funds by performance, risk, expense ratio, and investment objective. Many brokers offer educational resources and detailed fund profiles to help you make informed decisions. Another step is place your order, right? So once you have chosen a mutual fund, enter the amount you wish to invest and place your order through the brokers, their mobile app or their website. So most platforms allow you to buy fractional shares or set up automatic reoccurring investments, and then monitor and manage your investments. Okay, so track your mutual fund holdings and performance through your brokerage, right? Your brokerage dashboard, whichever that they, provide to you. Rebalance or adjust your portfolio as your financial goals or market conditions change. Now, here are some key things that you are going to want to consider for this strategy. Is the fees. So look for brokers offering no transaction fee mutual funds to minimize costs. Be aware of underlying fund expense ratios and any additional brokerage or broker charges for certain funds. The fund selection. Some brokers offer access to tens of thousands of funds, including both their own and competitors. Their products, allowing for broad diversification. You have account features, so consider additional features like research tools, customer support, and ease of use when choosing a platform. There is direct versus indirect investing. So direct investing, you're basically investing directly with a mutual fund company like Vanguard or Fidelity, which may offer access to the full lineup of the company's funds and potentially lower fees for those specific funds. Now, indirect, you're using a brokerage platform that allows you to buy funds from multiple families in one account, basically simplifying management and offering more selection. Now, here's a next mutual fund strategy, right? That was that one. We have, investing in mutual funds directly from fund companies. So this is known as investing in direct plans, which allows you to bypass intermediaries, resulting in lower costs and potentially higher returns due to the absence of distributor commissions. Now, here are the steps to invest directly, in mutual funds. You're going to have to complete a KYC, which is know your customer compliance, right? So before you can invest, you must complete KYC verification, which involves submitting identity and address proof and in some cases in-person or video verification. So this process is mandatory for all mutual fund investors in India, right? That's specific. So you can choose your investment method as well. So you can invest in direct plans either online or offline. Online method, you can visit the official website of the mutual fund company, AMC, you wish to invest in. Alternatively, use official, platforms like Mutual Fund Utility, MFU, RTA websites such as CAMS or, K FinTech or stock exchange platforms. You can log in or create an account, enter your KYC details, and select the mutual fund scheme you want to invest in. So you're going to want to ensure you select the direct option under plan type. Okay. After that, choose the investment option, whether it's lump sum or systematic investment plan, also known as the SIP. You're going to fill in investment details, verify all information, and make the payment through the available online options. So in result, you will receive, a confirmation via an email or SMS once the investment is processed. Now, there is an offline method, whether you're going to have to download or collect the mutual fund application form from the AMC or its registrar/transfer agent, RTA. You're going to have to fill in the form explicitly writing direct in the space provided for the distributor's ARN, or strike out any pre-filled ARN and write direct in bold. Then you're going to have to attach KYC documents and a check or demand draft for the investment amount. And then, submit the completed form and documents at the AMC's branch or RTA office. So you will receive a physical or electronic confirmation of your investment. At that time, you're going to have to track and manage your investments, right? So direct investors have full access to their portfolios via the AMC's website or app, allowing for transparent tracking and control. You can switch, redeem, or make additional investments directly through what they call the AMC or platform. Now, here are some key points to remember in this strategy. Direct plans have lower expense ratios and no distributor commissions, which can result in higher long-term returns. You must select, direct, right? We talked about that as the plan type. Otherwise, your investment will default to a regular plan with higher fees. Both online and offline methods are available. So but online is generally faster and more convenient. KYC compliance is mandatory before making any mutual fund investment. Now, here is the next way to invest in mutual funds, another strategy, which is investing directly with fund companies. Basically is ideal for self-directed investors seeking to maximize returns and maintain control over their mutual fund investments. Whether that's employee or employer sponsored retirement plans like the 401k, 413b, and similar defined contribution plans are one of the most common ways individuals invest in mutual funds for retirement. So here is the step-by-step for this strategy. Basically, investing in mutual funds through these plans, you're going to have to enroll in your employer's plan by enrolling in your employer's retirement plan, like the 401k or a similar offering. You'll choose a percentage of your paycheck to contribute, which is deducted automatically and deposited into your retirement account. Next, after that, you're going to want to select your mutual funds. Most employer plans offer a curated list of mutual funds to choose from, right? Including stock funds, bond funds, target date funds, index funds, and sometimes money market funds. You have to review the available options and select those that match your risk tolerance. A little bit more on that later. Your investment goals and time horizon. So decide on the contribution amount. So decide how much of your salary you want to contribute. Try to contribute enough to capture any employer match, as this is essentially free money. Then you have to adjust and monitor your investments, right? So you can usually change your investment, choices and contribution amounts during open enrollment or at specific intervals during the year. Periodically, you can review your portfolio to ensure it remains aligned with your retirement goals. Now, here are some key considerations to take for this strategy. There's employer matching, right? Many employers match a portion of your contributions. up to a certain percentage of your salary. So always try to contribute at least enough to get the full match. There are tax advantages, like contributions to traditional 401ks are made pre-tax, reducing your taxable income. There's Roth 401k contributions that are made after tax, but qualified withdrawals are tax-free. There's fees and share classes, so pay attention to the fees associated with each mutual fund. Lower cost share classes can significantly improve your long-term returns. Then there's diversification mutual funds that offer built-in diversification, but you should still ensure your overall allocation matches your risk profile and retirement timeline. Now let's look at a next way to invest in a mutual fund, which is financial advisors that guide clients, through a structured process to invest in mutual funds, ensuring the investments align with their financial goals, their risk tolerance, and time horizons. Now let's break down that process and how it typically works. So you have to define your investment goals and risk tolerance. Advisors begin by helping you clarify your financial objectives, such as growth, income, or capital preservation, and access your comfort with, the risk. There's going to be some risk now. These factors determine the types of mutual funds that best fit your needs, whether they are, equity funds or, that are, for growth, bonds for stability, or balanced funds for a mix of both. Then select the right type of mutual fund. So based on your goals and risk profile, advisors recommend suitable fund categories, stock funds, bond funds, money market funds, or balanced funds, right? They may also help you decide between actively managed funds, basically aiming to outperform the market. I don't know how effective that is, and passive index funds designed to mirror market performance at lower costs. You might like that one. You have to research and compare the funds, right? Advisors analyze fund options by reviewing historical performance, expense ratios, management teams, investment strategies, and, minimum investment requirements. So they also consider fees as lower cost funds that can significantly improve net returns over time. You're going to have to open an investment account, okay? Because you're doing it with them. So to invest in mutual funds, you'll need an account with the brokerage, right? The mutual fund company or the financial institution, wherever you're going. So advisors assist with, account setup, paperwork, and regulatory requirements. Then you're going to have to make the investment. You got to put some action to it. Once the account is open, advisors help you purchase mutual fund shares so you can invest in basically a lump sum or set up automatic contributions for ongoing investment, which can help with dollar cost averaging. Then you're gonna have to monitor and adjust your portfolio. There's a lot of monitoring in these things, So advisors regularly review your mutual fund investments to ensure they remain aligned with your goals and make, adjustments as needed based on changes in your circumstances or market. So there's flexibility, the market conditions. So why would you use a financial advisor, right? So there's a personalized strategy. Advisors tailor recommendations to your unique financial situation. There's professional fund selection, so they have access to research and tools to evaluate thousands of mutual funds. There's ongoing management, so advisors monitor performance, rebalance portfolios, and provide guidance, as your needs evolve. Okay. They also access, to fund information. So advisors provide a review fund, prospectuses, ensuring you understand the investment before committing. Now here's the typical steps in that regard. When investing through an advisor, you want to discuss the goals and complete a risk assessment. Review the mutual fund options and select funds. Open or use an existing investment account. Invest in chosen mutual funds, possibly setting up reoccurring contributions. Receive regular portfolio reviews and updates. Financial advisors streamline the mutual fund investment, okay? The investment process, making it more accessible and aligned with your long-term financial plan. Now, here are some types of ETF investing, okay? Because we talked about mutual funds, let's get into ETFs. So we have lump sum investing. So basically invest a one-time amount into an ETF of your choice. There's dollar cost averaging. So invest in a fixed amount at regular intervals, regardless of ETF price, to reduce the impact of volatility over time. There's all ETF portfolios. Basically construct entire portfolios using only ETFs, ranging from simple to ETF allocations, like one stock and one bond ETF, to highly diversified portfolios with 20 plus ETFs for fine-tuned exposure. Now, here are the types of ETFs to invest in. There's passive ETFs, which track a specific index like the S&P 500 for broad market exposure at low cost. There's actively managed ETFs like, portfolio managers, select securities in an attempt to outperform the market, usually with higher fees. There's sector and industry, ETFs, which focus on specific sectors like technology, healthcare, or energy. There's bond ETFs. You can invest in government, corporate, or international bonds, right, for income and diversification. There are commodity ETFs, which provide exposure to commodities such as gold, oil, or agricultural products. There are currency ETFs, which track currency pairs, allowing for speculation or hedging against currency movements. There's thematic and specialty ETFs, which target specific investment themes like ESG, sustainability, innovation, etc. There's inverse ETFs, which are designed to profit from declines in a particular index or asset using derivatives. There's leveraged ETFs, which aim to amplify returns and losses by using financial derivatives to provide multiples of an index's daily performance. Now, there are cryptocurrency ETFs as well, which offer exposure to digital assets like Bitcoin and Ethereum through regulated exchanges. There's portfolio construction approaches, right? They're simple. Like, you can use one or two broad market ETFs for easy management and rebalancing. There's moderate, which is you can combine several ETFs to cover major asset classes like US stocks, international stocks, bonds, etc., right? Those kinds of things. There's fine-tune, where you can build a portfolio with many ETFs for precise exposure to regions, sectors, bond types, commodities, and more. Now, here are some key things that you're going to want to consider. Diversification is one. So ETFs can provide instant diversification across asset classes, sectors, or regions, right? Now, the costs, to look into that, you can look for low expense ratios and be mindful of trading commissions, if any. There's a liquidity aspect, so ETFs trade like stocks during market hours, offering flexibility and real-time pricing. There's tax efficiency, like ETFs are generally more tax efficient than mutual funds due to their unique structure. Now, here are some key mistakes to avoid when investing in mutual funds and ETFs. So, investing without clear objectives, right? So you're gonna want to, starting investments without defined financial goals can lead to poor fund choices and reactive decisions during market volatility. So always align your investments with specific objectives such as retirement, buying a house, or funding. Like an example, education. Ignoring your risk tolerance, right? Investing in high risk funds without understanding your comfort with market swings can cause panic selling. Conversely, being overly conservative may not help you beat inflation. So assess your risk profile before selecting funds. That's 2. 3 is trying to time the market. So attempting to buy or sell based on short-term market movements often leads to losses. So mutual funds and ETFs are best suited for long-term investing. So stay disciplined and avoid reacting to market noise. That's what I have for you today. Please take a moment right now, hit that subscribe button and like button. I appreciate your viewership. Stay safe. See you on the next video.